Steve, can you share a short introduction to your career at Domino's, please?
Yeah, so I spent almost 13 years at Domino's. I was recruited to head up the Asia Pacific region based in Hong Kong. That was in 2007. And when I moved out to Hong Kong, there was a decent sized business already operating in the region. There were about 700 stores. We were in about 10 countries. And our revenues at the time, system revenues, were around $700 million. Well, over the next 12 to 13 years, while I was managing that region, I was really focused on accelerating growth, off of the, decent foundation that we have. And I grew the region from the 700 stores up to around 4,000 stores. And to approximately $2.5 to $2.6 billion in revenue. So it was just an amazing acceleration of growth. In the process, entered 6, 7 new countries, established the Domino's footprint for the very first time in a number of new countries. These countries included Indonesia, opened the first store in Indonesia, Vietnam, Cambodia, Thailand, Sri Lanka, Singapore, markets that had never ever seen a Domino's store before. A consumer that had not experienced Domino's pizza in their home country. They may have experienced it in other parts of the world. And that was a really exciting piece of the growth story, opening these new markets and taking the Domino's brand to new consumers, as well as really consolidating growth in some of the established markets. For example, a market like Malaysia, where we already had presence, but it was a small footprint, only about 27 stores, grew that to well over 250. Japan, where we had about 180 stores, a very decent sized business, grew that up to more than 700 stores. So it was really an incredible period of growth for the brand. And it was actually one of the fastest growing regions for Domino's on the planet. So just tremendous growth. Was that fine?
So can you share a brief history of Domino's in China?
Yeah, well, China was a very important project of mine, getting out to the region. There were 10 stores when I arrived. They were in Beijing. And the brand really didn't really know what it wanted to be, to put it bluntly. We had stores that had a very big dining area. We were selling fried chicken in our Domino stores. There was a delivery component, but the delivery and carry-out takeaway component wasn't the primary focus of the brand. It was more of a dine-in experience, more of a fast casual. And it really wasn't the core of what the brand was about, frankly. And so we struggled. These stores in Beijing weren't the very first stores. In fact, Domino's had opened stores in Shenzhen back in the 90s. And with the partner that we had there, they ran into difficulties, closed all those stores, and then a new partner came on board and moved the operation to Beijing, which really was interesting in that, probably wasn't the best city to begin operations in. We probably should have opened in Shanghai. So the focus for me immediately back then was to establish a presence in Shanghai. We also went through a master franchise change, brought in a new partner. We tweaked the model to have it be more focused on what is our traditional model, which is, primarily focused on delivery and carry out. We got rid of the fries, the fried chicken, really narrowed down the menu, and over a period of time, began to see momentum come into the business. And today, we have more than 300 units, which for China is not a lot of stores if you compare it to some of the other big QSRs. But there's a strong foundation now to really accelerate growth into the future.
Why was Domino's serving fried chicken and had dine-in in the first place?
Yeah, I think some of that had to do with the fact that Domino's primary competitor, was Pizza Hut. And Pizza Hut um, in China really was more of a casual dining, and initially was really the introduction to the Western dining experience. They had big, fancy restaurants, quite different to the red roof that we call them here in the US and other parts of the world. They offered all kinds of things on the menu, and Pizza Hut really introduced pizza to the Chinese consumer. So we felt in order to compete with them, we needed to broaden the menu. Fried chicken is a real staple in China. As you may know, KFC has been really the #1 success story in QSR. It is by far the largest QSR chain in China, with around 7,000 stores. And fried chicken is a staple part of the Chinese consumers' diet. They love fried chicken. And so at the time, Domino's felt that it had to have fried chicken, and they had to have real fried chicken, fried in real deep fryers, so then they could compete on more of a level playing field with the likes of KFC and Pizza Hut.
Do you still think that's the case today?
No, I think what has made Domino's successful in China is the focus on what is the core aspects of the brand, making really great pizza, and making a good quality product at a value price, and delivering that product consistently to a defined delivery area around the store. I think also what's made it successful is that it has grown, and with China, it's my belief that brands tend to gain more credibility when the Chinese consumer sees that brand more often. So, now with a 300 store footprint, penetrated quite well in Shanghai as well as in several other cities, consumers are getting used to seeing Domino's. They're trying Domino's. And also, many years have passed where, Pizza Hut, the pizza category, continue to grow, and Chinese consumers have gotten used to eating more pizza. And so this has been a great opportunity that Domino's China has seized, and now they're reaping the benefit of that.
And so you mentioned how Domino's had a partner in China, had some troubles, maybe financially in the Asian crisis, and then you have a new partner. So what's the current corporate structure and relationship with the master franchise in China today?
Well, there's a master franchise called Dash, and they have the rights to all of China. Previously, the franchisee, the master franchisee, only had rights to Beijing and Shanghai. Several years ago, with this new partner, the brand awarded the rights to all of China, and that was very important because that's allowed that master franchisee to attract talent, to attract investment, because investors and talent knows that there's a large scale opportunity. It had been difficult to hire the kind of talent that we needed when we only had, 50, 60, 80 stores, only with the rights to Beijing and Shanghai. Although they're big markets, bundling all of China under one master franchise has made it a lot more attractive for employees, for talent, for investors. Like I said, a very strong foundation now. And in fact, Domino's Pizza Inc., the franchisor, earlier on this year made an equity investment into that master franchisee to help it accelerate growth into the future, knowing that China is such a great opportunity going forward for the brand.
What's the rationale for the equity investment?
Well, I think it does a couple of things. It provides equity. It also has Domino's Pizza Inc. Being more involved at the board level, providing more support because they have an equity interest in the brand, and also to enjoy the potential upside that's associated with the accelerated growth that's going to occur in the coming years, and perhaps a possible listing, or just primarily, I think it's what better partner to have if you're a franchisee than the franchisor, right? It's really a win-win situation for everyone, but primarily it's to really guarantee that growth is accelerated.
What are the major differences in the Chinese market versus other Asian countries you worked in?
Look, China is just a monster. It's a big market. The opportunity there, the scalability is just mind blowing. Some of the cities there in China are the largest cities in the world by far. I think some of the challenges that we have as a brand, that Domino's has as a brand in China, is that pizza is still a relatively new food for Chinese. As we see new generations, I think they're becoming more comfortable with pizza. Really, dairy has never been a staple of the Chinese diet. I think that's changing.
Is it changing?
Yeah, I think it's starting to change. I think you're starting to see, there's more than 2,000 Pizza Huts. There's, 300 Domino stores. We've got McDonald's.
But Pizza Hut doesn't really sell much pizza though, do they?
Well, they do sell a lot of other things, but they really did introduce pizza to the Chinese. Starbucks has grown tremendously. So, as far as dairy, lactose products, milk, cheese, I think the Chinese are being more exposed to those products as there continues to be expansion of those products into the country. I think the Chinese consumer is willing to try different things and new things. And, I kind of use the example of, kids now that are 5 or 6 years old in China love to have pizza, right? So, this new generation that are being exposed to pizza, that are being exposed to dairy, are enjoying it. I don't believe that there are major issues with, lactose intolerance. And I think we're going to see Chinese embrace dairy products more and more in the future as they continue to experiment with, all kinds of different foods in the future. It's just part of their evolution.
How does Domino's as a brand overcome the Chinese aversion to dairy products?
Well, I think as Domino's grows and as Domino's provides terrific value and convenience with pizza and various offers to stimulate trial. Um, it's all about taste, and I think Chinese consumers are trying pizza. They're enjoying it. The pizza there can be quite different in terms of some of the other toppings that go on the pizza. Like we do a lot of seafood pizza in China. There's also a very successful potato pizza, but there is always a foundation of cheese. And so, um, you know, my experience with Domino's in China has always been, we haven't, we, we, we suffered from, a lack of, I'm sorry, I got stuck. We should probably cut and edit. We never really had any issue with consumers not wanting to try the product. It was more a question of the availability of a Domino store, getting the pricing right, getting the menu right. We do have a pretty high degree of repeat business, but it will take some time. The frequency level of pizza in China is not what it is in other parts of the world, but I think that will change over time.
And how does the Chinese consumer really compare pizza versus other Western foods like KFC or even their own dishes in terms of like how they consume it? Is it dine-in? Is it delivery? And when and how? And
Well, I think the Chinese are consuming more and more pizza every year because of the availability of pizza. Not only has Pizza Hut grown, Domino's has grown, but other brands from around the world like Pizza Express have opened in China and are growing. And we're also finding pizza appearing on the menus of other types of restaurants. We're seeing more Italian restaurant chains open as well. And so, I believe Chinese are being more exposed to pizza, and that's what's helping the growth of the category. It's going to take time. Domino's it will take time for Domino's to really scale. It's a very big country. Domino's strategy is to really fortress certain cities before it spreads itself out to all of the different provinces. It's going to take some time. To scale up to 1,000 stores will take several years, and the potential beyond 1,000 stores is several thousand stores, and there's nothing to stop Domino's from growing to 3, 4, 5,000 stores in the future in China.
and I read that historically the Chinese consumers didn't necessarily order pizza for delivery, but would only obviously consume it when it was dine-in by at Pizza Hut, for example. How did you see that change potentially?
Yeah. Well, actually, it changed a lot around 5 years ago when we saw the proliferation of the food aggregators. Food aggregators owned by Alibaba, Tencent, Ele.me, that really exploded and just expanded the delivery category overall in China. I think to this day, there's something like 40 to 50 million deliveries that are taking place through these aggregators in China from a number of different restaurants. I think that was prior to the aggregators coming on the scene, there was awareness of pizza. But you're right, most of the pizza was consumed in the restaurant, at the store. With the aggregators bursting onto the scene, 4 or 5 years ago, the habit of ordering and having food delivered was created. And I think that really helped the pizza category, especially on the delivery side. And so now we are seeing the majority of Domino's sales coming out of delivery. Prior to the aggregators, delivery accounted for about 30 to 40% of the business. Now it's way up in the 70 percentile range, having to do with the aggregators and also just the digitalization of the ordering process with delivery, right? So everyone now has an app. On that app, there are a number of restaurants. And in fact, Domino's leverages the aggregators in China, and that also helped boost Domino's awareness and also Domino's reach, leveraging the incredible, mighty presence of these aggregators that continue to be very strong in China, and have really changed the habit of eating out versus now being more open to getting food delivered.
Did they order pizza for delivery though, or was it more Chinese functional?
Frankly, they're ordering everything, and they order pizza when they feel like eating pizza, and when they feel like eating pizza, and if they have Domino's close to them, they'll typically choose Domino's. So they're ordering everything. These delivery aggregators are delivering, they're delivering noodles, they're delivering, traditional Chinese food, they're delivering Japanese food, Thai food, they're delivering
and
everything.
The price is competitive.
Well, if we look at, there's a lot of what they're delivering tends to be very low-priced items, which has raised the question whether the model is viable in the long term for the aggregators. The average check on pizza tends to be a little higher than other fast food like fried chicken or burgers or other
How
Chinese
much higher
food.
is it roughly to Chinese food and Western ones?
I would say, based on our research, in terms of what the average check on an aggregator order, the average check for a pizza order would be the double of what the average check in general is for an aggregator. So that makes it more viable for the aggregator. Now, it's important to point out that Domino's may take the order through the aggregator, but the food, the pizza, is then delivered by a Domino's delivery driver. The brand does not allow third-party delivery drivers anywhere in the world to deliver Domino's products. So they leverage in some countries, and especially in China, the delivery aggregator network and their portals. The order is sent to the Domino's store, and then a Domino's driver will complete the order, take it to the consumer, to their home.
Why is that?
Well, Domino's believes that it needs to ensure food safety and quality. So the decision was made in order to protect the brand and to ensure that quality control is kept from when the product leaves the store and gets to the consumer. It's handled by one of our drivers. We have a network in place anyway in every single store to handle deliveries. And so we leverage that. And it also helps to negotiate better rates with the aggregators, in that they're not having to do the actual delivery.
So the aggregators are just purely a demand generation channel for Domino's in China?
Correct. It's an acquisition channel. It's a pass-through channel. Domino's feels it's important to participate with those aggregators in China because they are so big.
And is that also because Domino's doesn't have as strong a brand as it would in the West? Do they have to use that to kind of get scale and leverage?
Yeah, that's partly the reason. You have to understand that these aggregators are behemoths. These are multi-billion-dollar companies, and offer all kinds of incentives to consumers to utilize those services. And yes, when Domino's partnered with these aggregators, there only were around 100 Domino's stores, and so the aggregators actually did help as well with creating better brand awareness for Domino's. So yes.
But why does Domino's use aggregators, for example, in China, but not touch them in the US necessarily, or the UK?
Well, because in the US, they believe that they don't need them, and the brand is right here. They've spent many years establishing the brand. It's a 60-year-old brand here in the US. Have invested millions and millions in providing an incredible digital interface with consumers, as well as an incredible, robust digital infrastructure to handle orders and deliver those orders through its fleet of delivery drivers in more than 6,000 stores. Domino's believes that it doesn't need the aggregators. Partnering with the aggregators would only eventually lead to cannibalization of margin. To date, there are no plans to partner with aggregators, and I don't believe that will change anytime in the foreseeable future.
Let's assume it's 2030 and we look back, and what would be the reason why Domino's didn't resonate with Chinese consumers?
Well, I mean, I don't think we're going to look back in 2030 and see that. I think in 2030, we're going to see, most likely thousands of Domino's stores in China. We're going to see it present in probably 50 or 60 cities all over the Republic. I see in 2030 Domino's continuing to expand at the rate of 200 to 300 stores a year. I have all confidence that because of the foundation that's been established there, that Domino's will have success going into the future in the next 10 years.
Does it need to
Now, go ahead.
Does it need to reduce the price? You mentioned how it's almost double the ticket for.
Well, I mentioned it was double the ticket versus what the average aggregator is delivering, right? In that, but if we look at the average price of a Domino's order in China, it's incredible value when you compare it to other menu items and other categories. Typically, when you order from Domino's, you're not ordering just for yourself. You're ordering for at least one other person, maybe a family of 3 or 4. Family sizes are starting to grow in China, so it is good value. It's not expensive. It's good value, and I think that as long as Domino's continues to provide exceptional value, exceptional service, with great taste, I think they'll be very, very successful. It's really the formula that Domino's has used all over the world, and it's made them the #1 pizza brand in the world today.
And you mentioned 250 to 300 stores a year. That's all through franchising.
Well, yeah, currently all of the stores in China, to my understanding, continue to be owned by the master franchisee. And so they effectively are, equity-owned stores by the the master
It's not
franchisee.
sub-franchising.
I don't, there's no sub-franchising so far. That may change in the future. Sub-franchising per se has not been as popular in China, with some of the other big QSRs. For example, Yum China owns all of its Pizza Hut stores, did not sub-franchise. They did a little bit of sub-franchising with their KFCs, but then pulled that back. Starbucks owns all of their stores. McDonald's owns all of those stores. And simply put, if the returns are there, and returns in China are quite good, there's a lot more control that you can maintain over having equity stores. You can control that growth, and also sub-franchising is a relatively new concept still today in China. That may change in the future, but the bigger brands have found that there's more ability to control, and to manage their destiny by continuing to own and operate the stores. And I believe that makes sense. Now in the future, Domino's may decide to sub-franchise to what Domino's calls internals, right? So if there are very good store managers that have been with the brand for 5-10 years, and they would like the opportunity to own a store, that could be a possibility for kind of entering into the sub-franchising side of the business. It's the formula that Domino's has used all over the world that has been the most successful, utilizing internals that understand the system, that know how to operate stores, who then become owners and own their own stores.
And how does that work? Does Domino's put up part of the cash, or is it purely the store owner has?
There's all kinds of different models that Domino's has all over the world. Some where they provide financing, some where they provide kind of a eventual kind of rental type buyback based on profits. There's all kinds of different models, and so it's kind of difficult to narrow it down to any type of one type of system there.
So do you think the original competitive advantage of Domino's, say in the Western world, still applies in China?
I do. I think it applies everywhere, which is a real acute focus on execution, right? And like what I like to say, sticking to the knitting, right? The Domino's business model, the reason why it works very well is because it is very, very focused, and it's also very, very simple. That said, you really need to be maniacal in terms of execution. And Domino's measures everything. Everything is measured in time, frequency, a lot of KPIs around how a store is managed. There's an acute focus. Menus tend to be quite narrow. It's all about pizza, and offering some sides, not such a broad range of sides that it complicates the operation. It's all about driving volume. Domino's talks a lot about HVM, high volume mentality, and really being ready for the rush. If orders come in quickly at dinner time, it's all hands on deck to get those orders processed, to get the food prepared, and to get that food delivered to consumers in 30 minutes or less. And in fact, they changed the benchmark recently to be now, 25 minutes or less. And there are stores around the world that deliver in 20 minutes or less. So it's very much focused on pizza delivery, as well as, providing an option of convenient carry out or pickup. And we've seen during the coronavirus how that side of the business has really seen a huge uptick where, consumers really don't want anyone coming and delivering product, though they'd rather go and pick it up. They have something which is called, curbside contactless delivery, that a contactless pickup. They have contactless delivery. So, really focused on delivery and carry out. There's not a lot of dine-in that happens at a Domino's store. In fact, most of the stores are not really configured for that, although, there is some seating available for those who, want to come in, order, and have their pizza right away. But it's all about the focus on pizza delivery, providing great value, doing it quickly, and also, that digital access, continued investments in, having that consumer interaction be seamless, be fast, and, for the experience to be extremely consistent. And it is. In general, that's what's allowed Domino's to grow to 17,000 stores around the world and growing.
When you
Because of that.
compare that to just let's compare the US versus China for a second. And clearly in the US, it's the home of Domino's and strongest brand, therefore almost 100%, or if not 100% direct traffic, own the logistics networks, close to the customer. Whereas in China, it's less of a brand, also generating demand via aggregators. I'm just curious of how you look at really the compare and contrast the really competitive advantage of Domino's in both countries.
Well, it's taken 60 years for Domino's to get to where it is in the US today, right? It will take time for, Domino's to scale in China. But fundamentally, the business model is identical. I believe that overall, the consumer needs are the same. There are some nuances, as we mentioned before, Chinese and dairy, but I think that will change as time evolves. When you go to China now and you walk into a mall, it's all the stores, and all of the boutiques and concepts that you see here in the US. I mean, that wasn't the case 20 years ago, and certainly, 40 years ago didn't exist at all. So it's evolving. And I just believe that it will take some time to, build and develop and scale the market. But it's happening. It's going to accelerate. And as we discussed, by 2030, it will be, I believe we should have well over 1,000 stores. And by 2040, 20 years from now, could be as big as 5,000 stores. I personally believe that eventually the China market will be bigger than the US for Domino's. I mean, that's my belief, that over time, China will be the biggest Domino's market in the world.
How do you compare Domino's versus Pizza Hut and Papa John's in China?
Well, we talked a little bit about Pizza Hut. Pizza Hut being more of a casual dining, restaurant focus, more on, dining in and, offering other, products on the menu, not just pizza, but, salads. And they even have steaks and all kinds of different items, a lot of desserts, beverages. Um, Papa John's, frankly, has struggled in China and have not grown tremendously. Not really sure where they are right now. I mean, they've had their struggles here in the US. They're getting back on track. And I think, the pandemic has certainly helped Papa John's, but they definitely went through some challenges with the brand over the last couple of years. But interestingly, Papa John's, as they were expanding in China, also went kind of the Pizza Hut route. So, they opened very big restaurants, also expanded the menu, and they were kind of like a Pizza Hut, me too. I mean, that if you walked into a Papa John's, I mean, they were huge menu, many pages of foods, and weren't really focused on delivery. And I believe they're trying to unwind that. But I know that they have definitely struggled and wouldn't be able to tell you how many stores that they have right now, but I can tell you that they haven't grown much at all in the last 10 years.
And given the number of countries you've worked in, what are some of the key takeaways from watching the aggregators penetrate the market?
Yeah, well, interesting question. I think you really need to be very thoughtful in your strategy, in how or even if you partner with aggregators. I think as they were starting to explode, certainly in my region, in the Asia Pacific region, there was almost a kind of panic set in many markets, in that they were growing so fast and they were offering all kinds of incentives to the consumer to try them, and they were competing and over the short term hurting Domino's in some markets, right? And some markets made the mistake to partner with them and immediately saw a rather important percentage of their business shift, with really not a lot of incrementality in sales, but obviously some erosion in terms of profitability and margin because of the commissions that they needed to pay to the aggregators. So what the brand decided to do, which was really the right move, was to tell all of the markets, stop, no one can sign any new deals. Each market needed to go through a rather vigorous and rigorous justification and kind of business model evaluation to determine whether it would be in the best interests of the brand to get into a partnership with the aggregator.
And what was that decision-making process?
There were a number of factors. First off, the decision was made by the brand at the same time that no aggregator would be allowed to actually physically deliver the food. That was kind of a line that was drawn in the sand. If you are working with aggregators right now and they deliver your food, that needs to stop. So that was.
And that's because of the consumer experience and the branding of the Domino's person delivering.
Exactly. Because we were looking at some of these delivery aggregators and the delivery drivers and what they were wearing and just we were concerned that there could be potentially food safety issues and just image issues in general with the product once it left the Domino's store. So that was the number one mandate that was established globally. And then with respect to whether a market would enter into a partnership with an aggregator depended on several factors. How big a market share Domino's had in that particular market, how aggressive the aggregators were, what type of commission that they would charge, what type of contract was in place. There were also certain mandates on whether data would be kept by the aggregator or not shared with the aggregator, all kinds of privacy issues with respect to our customer, who retained the customer data, and so forth. Just a number of parameters that each market needed to evaluate to determine whether the brand would allow them to enter into a partnership with an aggregator.
Doesn't the aggregator just keep the data in every market of that customer?
It depends. It depends. I mean, there are some aggregators where they do, but ultimately the order will go to the store, and then our drivers will deliver to a consumer. So we know where that consumer lives. I think there was a lot of focus on trying to convert those customers that had come in through aggregators to direct customers for Domino's. We would try to steer them towards our own, Domino's.com site in the particular marketplace, and offer them incentives to work directly with us versus working with the aggregators. In some markets, those aggregators continue to be a percentage of the I would say, the revenue channel or acquisition channel for customers. In some markets, aggregators are utilized maybe more so in highly urbanized centers like downtown centers of, say, a Melbourne or Sydney, where aggregators are very, very predominant. And when you get out to more rural areas, aggregators don't tend to have as much dominance, and because their business model tends to struggle out in the suburban type areas.
How would you look to try and convert those customers that purchase via the aggregators?
Well, by talking to them directly after.
You mean actually ordering it on the door? You mean a flyer physically?
Yeah, flyers. Bounce back coupons. There's a loyalty program that Domino's has. Some of these aggregators have their own loyalty programs, but different types of incentives that were only available to consumers if they ordered directly through Domino's.
And this is going to be a key part of the challenge in China, I guess. If the majority of the market are ordering via the aggregators, trying to shift them to your own channel is going to be tricky.
Absolutely. That I think Domino's in China is seeing that. As long as the contracts that Domino's China have in place with the aggregators, with certain levels of commission. Remember, the aggregator does not do the delivery, so the aggregator, really does not have a right to charge too much commission on that order, because really the order is just being placed through the site, and then it gets funneled.
So it's like half the typical 30%.
Yeah, I mean, I think it's even less than
12% roughly. Yeah.
I'm not exactly sure what the percentage is right now, but it's a manageable number. That we've done the math, and look, for the aggregator, the aggregator, it's a profitable channel for them, right? Because all they're really doing is passing through the order to the consumer. They don't need to get involved with the delivery. So it is a good margin. Hopefully they continue to see and realize that, and don't get too greedy, but you never know.
How does that change the economics, the store unit economics for Domino's in China?
Well, I think if that commission is reasonable, it's manageable, right? Because, it is a good acquisition vehicle. These aggregators are doing a lot of advertising. They have incredible presence. And if you are on their homepage and you're getting exposure, well, it works nicely. And so far that's been working. Domino's has been getting a significant amount of traffic from those aggregators.
And the cash
Now,
payback is similar to what it would be in the US, or different due to the aggregator demand.
I mean, yeah, I mean, I couldn't tell you the exact numbers, but in the US, we don't use aggregators at all. Now, the business models in terms of margins vary, depending on a lot of things: labor rates, food costs, rents, and so forth, and even advertising costs in general. Domino's in China is not really doing any television advertising, so their actual budget, marketing budget, is different to the US, and so some of their marketing is really with the aggregator, right? So just in that commission that they pay. It's difficult to compare apples to apples, with Domino's in the US or China, and in fact with any other market, because there is quite a variation. Also in average ticket, labor rates vary significantly, food costs, and so
But
forth.
it seems like it would be lower than that 3-year cash payback that it seems to be, or that the franchisees seem to get in the US for Domino's, due to the fact that the demand is somewhat driven by aggregators and they've got less of a brand, and potentially they own the stores as well in China. So is that payback, is it a longer payback period typically in China versus?
Actually, quite similar. The unit economics are very robust right now in China, based on the volumes and based on a number of factors. The investment cost of a new store, and as I mentioned, labor rates are significantly lower in China for now. That may change in the future. But when I was involved, and I don't really see that there would have been much change. Average unit paybacks on new stores were very good. Were very good, well within and better than expectations, typical expectations.
Which region had the best cash paybacks, and why?
Yeah, yeah, good question. I also was associated with, just an incredible growth period with India. When I took over the region, there were about 125 stores. When I retired from Domino's last year, they were approaching 1,300 stores. So just phenomenal growth in a period of 10, 12 years. Unbelievable paybacks in India. A lot of that having to do with labor rates being very low, as well as food cost was quite reasonable. As you may know, or I'm not sure if you know, but there is a dairy industry in India, so there's no need to import cheese and dairy products from anywhere else in the world. Another factor that makes the returns pretty good there is that more than 55% of all pizzas are vegetarian. So, there aren't that many meats and more expensive proteins that go onto a pizza. And so when you've got more than 55% of all of your pizzas being vegetarian, that helps margins significantly. The cost to build a store, relatively reasonable. Now, that said, the average ticket was quite low, but very high volume business, very, very good returns. One of the best returns that we have, that Domino's has in the system. Malaysia also has very good returns, probably driven in Malaysia primarily by occupancy costs, believe it or not, because of kind of the shop house type of real estate that Domino's would look at. efficient for the brand. Was a really big um, a big area on the P&L that was a lot better than in many other markets. In some stores, I remember seeing um, occupancy rates of under 2%. Which is phenomenal, as well as low labor rates. Yeah, I mean, some of these shop houses would rent for $500 or $600 a month, right? I mean, it's very much shop house driven retail landscape in Malaysia. That may change in the future. Also, the cost to build a store was extremely low, so some of the best paybacks as well for the brand. Master franchisee, also a very good operator, very well experienced operator. Very focused on managing the P&L, managing costs, and not at all, um, uh, you know, uh, trying to drive prices towards the consumer. Very, very value focused as well. So a combination of great value for the consumer, um, you know, reasonable costs in the P&L make for great returns, as well as a very reasonable investment cost to build new stores.
And what are the typical reasons or risks in cash payback lengthening?
Yeah, well, I mean, I believe that the more you spend on building a store, and there are some countries where it does cost a bit more to build a store, that will affect your payback. So if you tend to over outfit your store, and there are some markets who have kind of I would say improved, the overall fit and finish of stores, because that's what has been demanded in the marketplace. The overall retail and restaurant landscape requires kind of a more upscale look. That ultimately costs more, and so that may affect some paybacks in the short term, as you work your way through, trying to get that investment cost down. The other side of it is when labor rates are extremely high. For example, in Australia, has some of the highest labor rates in the world. That can affect payback rates. There's a lot of kind of socialized labor rules and penalty rates for drivers on weekends or during public holidays, where they are required by law to be paid twice the normal rate, or 2.5 times the normal rate. So that will drive up costs that will ultimately affect the payback. So probably the two biggest areas, answering your question, would be that initial investment cost of a new store, and if you've got a high labor rate as well, that will kind of throw off your economics a little bit. But good news is, overall, if you go around the world, it's somewhat balanced. If you look at the overall system, it's pretty well in line. The goal is to have a payback within 3 years.
And what are your biggest lessons from managing master franchises?
Oh, wow. Probably um, the biggest learnings and lessons, um, when I came out to the region, we had markets that had different, were at different levels of the evolution of their brand. And so, it's one thing to manage a master franchisee that has 200 or 300 stores, versus how you manage and communicate and work with and support a franchisee that has 100 stores or 30 stores or 0, who are just starting, right? It takes a very, very different approach and discipline, working through the different scale size of the master franchisees. As well as, along with that typically comes the level of expertise that you have on the management team of those master franchisees. For example, when you've got a business that is, 5 or 700 or 1,000 stores, the type of talent you can attract and afford to pay is very different to when you're in the startup phase, right? Where you're opening your first store, or you have 5 stores in that marketplace. So just, the diversity in terms of the scale, the size, the 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 depth and breadth of the management team within that master franchise, within that master franchise group, was a continual learning process. And then also, there were master franchisees that I worked with that were, 100% and only invested in and focused on Domino's. And then there were other master franchisees who had several other brands, and just trying to manage within that type of culture where and some of these master franchisees had some very, very successful and already well-established brands that they were operating. And, Domino's was the new brand that came along. And so, working within that type of framework could be quite challenging at times. I think, the most important lesson for me was to, stay focused on, what our brand was and what the fundamentals are, and, just being insistent on, what each partner, each market needed to do in order to get from here to there, right? There are certain very disciplined steps. Focus on the customer, focus on execution, stay true to the model. It's all about, fast delivery, fast and safe delivery, sticking to the formula. And
And
if you do that, you're going to be successful.
how do you look at the value add of fortressing as a strategy?
Yeah, well, I mean, very, very important strategy, and a proven strategy for Domino's, in that, um, you know, ensuring that, before you start expanding to other cities within a country, to really have, gotten to scale and have fortressed and continue to fortress um, the current city that you're in. We've learned a lot. Domino's has learned a lot over the years, and using great consumer insights and data, and especially fortressing really is important when you're trying to um, uh, you know improve service times on delivery, as well as growing your carry out and takeaway business. And that, part of the fortressing strategy would be where we would perhaps have 2 stores operating. We would open a store in the middle of those 2 stores. We may take some revenue from each of those 2 stores that were in that particular trade area, but the overall revenue would grow. And then eventually, by providing better service in those 2 stores that have been cannibalized, we would find that revenues would eventually return to a very similar place to where they were before they were cannibalized by the new store. So that is really what's at the core of um, the fortressing strategy, is to continue to really be more and more accessible to a market. There may be some short-term cannibalization in sales in existing stores, but by improving service metrics, because you can get faster, focus on perhaps fewer customers, you can get sales back up again. You ultimately drive the carryout business, because the carryout business will be all incremental from a new store. We've proven time and time again that it works, and
But doesn't
it's
it
a
create
strategy.
tensions with the franchisee if you cannibalize their store and they don't open that new store?
No, because we've been able to prove with data that it works. There may be some short-term effect, but we've found that over a period of time, the overall impact is significantly positive. And so, we will lay that out with franchisees, here in the US, and show them exactly how it works. They understand it. We'll also provide some incentives for them to build a new store, right? So that, all the incentives, when you add in the incentives, the incremental revenue out of the
Like
carryout
better
over the new
royalty
store,
rate or
all
just
different types of incentives on, build out costs, and possibly on royalties. It's always changing. The programs
but
change all the
in the
time here.
UK or the Australia, it seems like there was some franchisee pushback over the last 4 or 5 years and or over in that regions. How do you look at that?
Yeah, I mean, I'm not too sure about what was happening in the UK. I didn't have much responsibility in that particular area. My understanding is that they're working through those issues. It's all about continuing to grow. Franchisees, yes, I understand they may be concerned about the short-term pain with additional stores opening in the marketplace, but with the data, you can show the franchisee, and with appropriate incentives, you can demonstrate to the franchisee that there's a net gain from the strategy,
And
and
do you look at
in
that
fact works.
profitability of them? So you would say, right, this
Of
franchisee
course,
and
yeah. I mean, Domino's has always been very, very focused. Part of my role was always to be very, very focused on understanding the franchisee's profitability. Here in the US, I know it's the number one priority for the system here. Anything that Domino's does, anything new that it does, if they're looking to launch a new product, it's all through the eyes of franchisee profitability. If we launch this product, will it mean not only more sales but more profit? Importantly, more profit for the franchisee. That's really the benchmark that the system looks at.
Steve, what's the biggest risk in the model?
Well, I think, like any model, if your execution level is not at the optimum level that it should be, you have the possibility of not satisfying consumers, um, perhaps late deliveries, which in turn doesn't satisfy the consumer. At the end of the day, the risk to the model is if the execution is not there, that will ultimately lead to customer dissatisfaction, which will lead to lost sales, and obviously the model is vulnerable. I believe that there are sufficient audit controls and benchmarks in place to ensure that stores are operating at the highest level operationally. The brand is always, has always been very, very operationally focused, and so I believe that is probably the biggest risk. You know, the other issue, that Domino's talks about too is, food safety has always got to be, paramount, right? So if for whatever reason there is some type of, E. coli outbreak, or some kind, and we've seen it happen, across all of the brands, in the world. If that was to happen on a wide scale in a country, that could potentially be quite damaging for the brand. Um, at least for the midterm. And we've seen it happen, you saw it happen in China with McDonald's. It's happened here with Chipotle in the US, and they now seem to have completely recovered, but it took them several years. I mean, that's probably the other big area that could be, risky for the model. But, I think, Domino's, has, very stringent procedures in place, for food safety and hygiene. And so, they're always looking to minimize the risk on that. But it's always, you never know.
And
It could happen.
Steve, last couple of questions. And why can't other competitors replicate this model? Well, what is the secret?
Yeah, well, I mean, it's not easy. I mean, sometimes, when I talk about it, it sounds very simple. You're just focusing on, but to actually, create a culture that is, just maniacally focused on one thing. And, Domino's really invented the pizza delivery business. If you go back 60 years, a lot of innovations in the category came from them. They invented the car top, the car top sign that many, delivery companies use now. They invented the heat bag, just the number of the first conveyor belt oven. But to execute, maniacally in 17,000 stores and growing every single day is a lot harder. To deliver pizza on time, to have the discipline, the incredible amount of capital that's been invested in technology to create, such a robust, ordering platform.
Is it the ordering
Just
platform, or is it the relationship with the customers, or is it more like the back end?
I think it's all of that. Really leveraging consumer insights that you can get from the data that's generated from all of the digital transactions. Really, mining that data and all of the learnings over the last several decades on leveraging that. I believe creates a strong barrier for competitors, and the international side of the business is difficult. There are few brands that have the footprint internationally that Domino's has, and you can name them, maybe 5 to 10 brands, right? And why have they been successful? Because they are just maniacally focused on what they do, where they were established here in the US. They don't deviate from what their model is, continuously looking to understand more from the consumer, innovating in terms of technology, always, ensuring that standards are consistent
How do you
throughout
do that,
their.
Steve? What do you look at? Let's say that you're managing your 4,000 stores. What are the KPIs that you'd be looking at for those stores that would make you maniacally focused on really what matters?
Well, in every store has, what we call an evaluation report that we perform on those stores, at least once a month. Many stores perform those evaluations once a week, and there are other checklists that are performed, once a day that ensure certain standards are
Like
absolutely met.
order growth or turnaround time, delivery time?
Yeah, all of that. Leg time, wait time. We call rack time, when the pizza comes out of the oven and it's sitting there before a driver picks it up. And we measure everything. And now with GPS technology, we're measuring our drivers, how long, which routes they're taking, to a store, on the way back, how long they're spending in the parking lot before they come back in. everything in Domino's is measured and analyzed. And so, and those are global standards that are applied to the system everywhere. And
And
I
if a
think
number's
that's what
out, you kind of you hone in on that number and want to
absolutely
know
we get
why.
all kinds of exception reports that say, okay, we've been late consistently. The other success story I think for Domino's is that it has a global point of sale system. It's the same point of sale system that's in all of the stores. So everyone is being measured the same way, and that's important. It's taken 60 years for Domino's to get to where it is, and that's not to say that there may be a challenger brand one day in the future, but in the future, you know Domino's will continue to be successful. They will continue to grow. They'll continue to fortress. They will gain market share. And I think it's highly unlikely, unless you know the company is not managed properly, or for whatever reason, it's highly unlikely that they should diverge from the trajectory that they're currently on.
Steve, this has been great. Thank you very much for your time.
Enjoyed it as well. Thank you.